Today, let's go over top 10 Canadian stocks that you should consider adding to your portfolio. If you buy these stocks in your TFSA account, then you do not pay any tax on the money that you make with these dividend stocks. Hello all you lovely people, welcome back to my channel where we talk about investing, personal finance, and dividends. If you're new to this channel, please consider subscribing to my channel and smashing that like button for the YouTube algorithm gods. Let's get started. Buying a dividend stock is a safe way to protect your money from losing value due to inflation. On average, in Canada, the inflation rate is 2%, which means every year your money loses 2% in value if it's just sitting in a checking account and not invested anywhere. If you have your money sitting in a high interest savings account, which on average returns 2% as well, you're technically not losing the value of your money, but you're not making any money either. If you have your money somewhere invested where the average return is higher than the inflation rate, then you're making your money make more money even through inflation. Buying well-known dividend stocks is one of the best ways to protect your money from inflation and make more money safely while you're at it. Dividends is a small percentage of money paid to you and me for investing in the company and holding on to their stock. They're basically like, we made too much money and you're part of the reason. Thank you. Here, take some money. It also encourages investors like you and me to continue to invest in these companies. In a few moments, I'll be throwing a lot of acronyms and numbers at you, and this is probably where I'll lose some of you lovely people. So if there's something that's confusing or not clear, please let me know in the comments below and I'll try to respond to all of them. These are my observations of the company. I'm still not a financial advisor, so take a look at these companies yourself, and if you like them, go ahead and buy them. Let's take a look at our first stock, TD, Toronto Dominion Bank. They're one of the 5 biggest banks in Canada. They have plans to expand into the US in the upcoming years. I do my banking with TD along with 10 million other Canadians. It has a dividend yield of 5.07%, which means every $100 that you invest into TD, you'll get $5.07 every year. This yield is currently 34% above average, which means it's slightly undervalued and it's probably a good buy. TD has increased its dividends consecutively for 9 years, and they have a dividend growth of 11%. Another interesting fact about TD is they've not missed a single dividend payout or cut their dividends in 25 years. That's amazing. They even managed to pay dividends through the 2008 housing market crash. Companies get added to a list every time they meet a milestone for dividends. If a company increases its dividends for 10 years consecutively, they'll get added to a list called Dividend Achievers. If they consecutively increase for 25 years in a row, they get added to a list called Dividend Aristocrats. In Canada, if you increase your dividends for 5 years consecutively, then you get added to a list called Canadian Dividend Aristocrats. And TD is part of it because they have increased their dividends for 9 years in a row. Finally, the best of the best. If you increase your dividends for 50 years in a row, you get added to a list called Dividend Kings. These are the best of the best companies for dividends, and they're the best options because they're not going to randomly cut their dividends or they'll get removed from the prestigious list. And these are the best options because the dividends are only going to keep going up. According to Simply Safe Dividends, TD has a dividend safety score of 80. Dividends are not owed to us by the company. They can cut it at any time or suspend it if the company is doing bad. This score helps us understand if the company is still going to be paying their dividends to shareholders like you and me, even through a market crash like we saw this year. The higher the score, the better. Scores between 60 and 100 are considered safe. They're most likely going to be still paying dividends even through a market crash. Any score between 40 and 60 is considered borderline safe. That means they're at a risk of cutting their dividends or suspending their dividends during a market crash if they have to. And anything below 40 is considered unsafe. They're most likely going to cut their dividends or suspend their dividends during a market crash. TD has a payout ratio of 57%, which means they use 57% of their net income to pay dividends to you and me, and they reinvest the 43% back into the company to expand and grow. A payout ratio anywhere around 60% is considered healthy as they're sustainable enough to pay us dividends and grow the company at the same time. Phew, that took a very long time to go over the first stock. But now that I've explained all the acronyms, you know what all the acronyms mean, we can go through the rest of the list very quickly. Next on the list is BMO. Bank of Montreal. They're one of the top 5 banks in Canada as well. They also have a set of ETFs that they manage themselves, similar to iShares, which is another large provider of ETFs, which is managed by BlackRock. It has a dividend yield of 5.23%, which is 30% above the 5-year average, which means it's slightly undervalued and it's a good time to buy as well. It has a dividend growth of 7%. They've also paid their dividends without missing for 24 years straight, and they've increased their dividends for 8 years in a row, which adds them to the Canadian Dividend Aristocrat list. It has a dividend safety score of 70, and its payout ratio is 54%. Next on the list is BNS, Scotiabank. You see a pattern yet? Canadian banks are a solid investment. TD, BMO, and Scotiabank are my top favorites from the 5 biggest banks in Canada. They have branches all around the world, about 46 different countries. It has a 6.5% dividend yield, which is 45% above the 5-year average, which means it's also slightly undervalued and it's a good buy. It has a dividend growth of 6%. They've paid dividends for 23 years straight and increased their dividends for 9 years in a row, which qualifies them for the Canadian Dividend Aristocrat list. It has a dividend safety score of 70 and its payout ratio is 63%. Next on the list is SLF, Sun Life Financial, and it's mostly known for their life insurance. They operate in Canada, US, UK, and some Asian countries as well. It has a dividend yield of 3.95%, which is 8% in line with the 5-year average, which means it's a reasonably valued stock. It has a dividend growth of 10%. They've paid dividends for 19 years straight, and they've increased their dividends for 5 years in a row, which means they get added to the Canadian Dividend Aristocrat list as well. It has a dividend safety score of 89 and its payout ratio is 41%. Next on the list is ENB, which is Enbridge. If you live in Canada, you probably already know this company. You use this company to heat your home and water. They transport natural gas all across the country here in Canada and in some parts of US as well. It has a dividend yield of 7.81%, which is 34% above the 5-year average, which means it's also slightly undervalued and it's a good buy. It has a dividend growth of 10%. They've paid their dividends 25 years straight and they've increased their dividends for 24 years in a row, which means they're added to the Canadian Dividend Aristocrats list and the Dividend Achievers list. It has a dividend safety score of 57 and its payout ratio is 67%. Next on the list is TRP, TC Energy. This is also another major energy transportation company like Enbridge, and they operate all across North America, Canada, US, and Mexico. They have 92,000 kilometers of gas pipeline all across North America, and they support 25% of North American demand for natural gas. It has a dividend yield of 5.33%, which is 18% above the 5-year average, which means it's also slightly undervalued and it's a good buy. It has a dividend growth of 9%, and they have paid their dividends for 19 years straight and increased it every year, which means they qualify for the Canadian Dividend Aristocrat list and the Dividend Achievers list. It has a dividend safety score of 61 and they have a payout ratio of 45%. Next on the list is T, which is Telus. It is a Canadian telecom company that provides cable, internet, and phone plans for both landline and cell phones. Telus is one of the companies that holds a monopoly for Canadian communications market, along with Rogers and Bell. It has a dividend yield of 4.77%, which is 6% in line with the 5-year average, which means this stock is reasonably valued at the moment. It has a dividend growth of 7%, and they've paid their dividends for 17 years straight and increasing their dividends for 16 years in a row, which adds them to the Canadian Dividend Aristocrat list and the Dividend Achievers list. It has a dividend safety score of 72 and it has a payout ratio of 89%. Next on the list is CNR, Canadian National Railways. It provides transportation services for basic goods as well as goods like petroleum and chemicals, which are dangerous to transport over road. It has 33,000 kilometers of tracks across Canada and in the US. It has a dividend yield of 1.6%, which is 9% below the 5-year average, which means it's slightly overvalued at the moment, and maybe wait a little and then buy the stock, but might be a decent buy. This dividend yield is really low. Anytime the dividend yield is low, you want to look for a dividend growth that's in the mid 2 digits or even close to 20%. CNR has a dividend growth of 18%, which is perfect considering the dividend yield is only 1.6. They've paid their dividends for 23 years straight, and they've increased it every year, which adds them to the Canadian Dividend Aristocrats list, Dividend Achievers list, and in a couple of years they'll be added to the US Dividend Aristocrats list as well. It has a dividend score of 97, which is very safe. They're not going to cut their dividends anytime soon. They also have a payout ratio of 41%. Next on the list is CU, which is Canadian Utilities. It's a utility company in Canada that provides generating, transporting, and distribution of electric and gas needs for all Canadians. It has a dividend yield of 5.48% and a dividend growth of 4%. They've paid their dividends for 48 years straight, and they've increased their dividends every year, which qualifies them for the Canadian Dividend Aristocrats list, the Dividend Achievers list, and the US Dividend Aristocrats list. It's the closest Canadian company that will make it to the Dividend Kings list, which is companies that have increased their dividends for 50 years in a row. It has a payout ratio of 77%. At last but not least, FTS, which is Fortis. It's also another utility company similar to Enbridge that provides gas and electric services to Canadians. It has a dividend yield of 3.6%, which is 3% below the 5-year average, which means it's slightly overvalued but still a good buy. It has a dividend growth of 6%. They've paid their dividends for 46 years straight and increased it every single year, which qualifies them for the Canadian Dividend Aristocrats list, the Dividend Achievers list, and the US Dividend Aristocrats list. This company is second in line out of all Canadian companies to make it to the Dividend Kings list. It has a dividend safety score of 62 and its payout ratio is 74%. A bonus one to this list that I have had my eyes on for a while is RioCan. RioCan is a REIT, which stands for Real Estate Investment Trust. They have a bunch of property that they rent out and collect money. This company helped build Tanger Outlet across Canada, and they also own a lot of shopping complexes and are expanding. It has a dividend yield of 9.67%, which is 72% above the 5-year average, which means the stock is undervalued. They've paid dividends for 23 years straight, but have not increased their dividends for 3 years in a row now. They have a payout ratio of 82%. It has a dividend safety score of 30, which is considered unsafe. But they're popular in Canada and they're expanding, so I think it will work out for the company. This is the most risky investment that I have in my portfolio. That being said, I do not plan to invest too much into this company, but just some here and there. Again, I'm not a financial advisor, I'm just a random guy on YouTube. But you should take a look at these awesome companies mentioned in this video and see if you want to add them to your portfolio as well. As always, make money work for you, not the other way around. You can check out Wealthsimple Trade and start investing today. I have another video that walks you through the setup for Wealthsimple Trade. I'll leave a referral link in the description box below. If you use that link to sign up, fund your account $100 and buy some stonks with that, you'll get $10 and I'll get $10 as well. Let's take personal finance into our own hands and make our money work for us. If you enjoyed this video, be sure to smash that like button and hit that subscribe button for more content like this.